Welcome back to everyone in the room and to those watching it on Bloomberg or on the live stream. I'm Stefanie Flanders, Head of Government and Economics at Bloomberg. That means there's a team of economists working under me, but also all the economic and political reporters. So I'm constantly thinking about both the theory of what's wrong with the European economy and the practice of how we might put it right. And the title of this session, where we have this fantastically accomplished panel, you will see, is How to Revive the European Economy and Unlock Its Potential. And I was thinking about this before the session, thinking there are many areas in which Europe's economy we should worry about and it had fallen behind. But one area that we surely excel in is in the study and comprehension of what's wrong with the European economy. I can't think of any other region in the world that comes close to Europe in the rigor and detail with which researchers and policymakers have analysed exactly what the problems are with the Eurozone economy. In fact, our own economists calculated last year that if the Euro area economy had just grown had kept up with the US since the beginning of the Euro, the region's economy would now be 18% larger, 3 trillion euros larger. And of course, that would have implications for many of the discussions we have today, because not only would average income per worker be around 13,000 a year, 13,000 euros a year higher, but there would also be more tax revenues, potentially more space for governments to devote to key challenges like defence that we're now talking about. I think we've also been pretty good at identifying solutions to these shortcomings, and indeed we saw Mario Draghi deliver his report last year. There were several hundred, 383 individual recommendations in that report. But of course, as we all know, the real issue has been in implementation of any of this. And there it's only been, I think it was calculated, 11% of those recommendations have been fully implemented, and around 2/3 have really seen no progress at all. So I'm delighted that we have seasoned policymakers and economists on this panel who not only have the keen understanding of what's wrong, but also from their practical experience working with policymakers and supporting good policies on the ground in their various capacities at various times. I'm sure they're going to be relentlessly practical and realistic in thinking about how to revive the Eurozone economy. And I get the impression even optimistic, which would be a nice change. We have Isabel Schnabel, who has been a member of the executive board of the ECB, obviously, since 2020. She had had a career as an academic economist and a banker before that. Andréa Maechler, deputy general manager of the Bank for International Settlements, who had previously been at the SNB and IMF, of course. And Beata Javorcik, who is the chief economist of the European Bank for the EBRD, European Bank for Reconstruction and Development, and a professor of economics at Oxford University. So thank you to all three of you. We're going to hear up to 10 minutes from each of them on the topic. Then we'll have a discussion and we'll also bring in the audience. So thanks very much. And Isabel, over to you.
Good afternoon. Thank you, Stefanie, for the introduction. It's such a pleasure to be part of this fantastic panel. And as Stefanie said, we want to be optimistic this afternoon. We want to be solution-oriented. So let me start by saying, and I'm sure everybody in this room and online is going to agree with that statement, Europe is a great continent. And it has a lot to offer. It offers a high quality of life, a high level of social security, a strong democracy with strong institutions protecting the rule of law. But all of this doesn't come for free. And to be able to maintain these achievements and to tackle the new challenges like climate change and the security threats, we need economic growth. But, and you've seen these kind of charts many times, Europe has fallen behind on productivity growth. And this is not a recent phenomenon, but this has been going on for a long time, over several decades. And one reason for that is that Europe has missed the digital revolution. And this is not just true with regard to innovation, it is also true with regard to adoption and diffusion of technologies. And European competitiveness is under threat because China has moved up the value chain. Some people call this the second China shock. And it has now become a main competitor in advanced technologies. So many of the technologies where Europe used to be very strong in. I mean, electrical vehicles is only one example, but it's much more than that. And as you can see on the left-hand side chart, the euro area has been losing export market shares, again, over quite some time. It didn't start with the recent trade war, but it started well before that. And of course, in turn, China's export market shares have soared. One issue that is displayed on the right-hand side is relatively high energy prices. And already before the pandemic, the energy prices in Europe were relatively high in comparison with areas like the United States. But of course, that was reinforced after the Russian invasion of Ukraine. And we all know that energy will be key for future technological advancements. So this is an area of concern. So what is needed? I would argue that the revival of euro area growth relies on three interconnected pillars. The first is integration, the second is innovation, and the third is sovereignty. Of course, none of this, as Stefanie said, is new. Many of us have talked about it for a long time, so, but sometimes it's good to say things again and again in the hope that people will finally act. So the first is integration. And we have this wonderful thing called the single market, which offers huge, unexploited potential. And this is still true for the trade in goods, but it's especially true for the trade in services. And even though some progress has been made recently in financial integration, of course also there is scope for more. So why is integration so important? As you can see in the chart on the left-hand side, euro area firms are very small on average. But we know, and the right-hand chart shows a study on Italy, we know that scaling up would have a significant positive impact on productivity growth. But all the bureaucratic and regulatory hurdles make scaling up across member states very challenging. Of course, what is needed is a certain degree of harmonization. But harmonization is a tedious and very time-consuming process. So I believe that a true game changer for integration and innovation in the EU would be the introduction of what many people call the 28th regime. So what is that? The idea is that you create a new EU-wide legal form for businesses that allows the firms to easily scale up across the entire European Union. Of course, this kind of 28th regime must comprise things like corporate law, insolvency law, tax law, labor law, and all of that are, of course, contentious areas. It could be wise to focus specifically on innovative companies, on startups, but importantly also scale-ups, because this is where the real issue lies. And by reducing the regulatory and administrative burdens, by increasing mobility of labor and capital, and by providing higher legal certainty, we would achieve a greater scalability of firms, and this in turn would lead to higher productivity and also more innovation, because the access to the large EU market would make it more profitable for firms to innovate. So for me, this is one of the key proposals that was in the Letter report, that is in the Draghi report, but what we need now is concrete proposals on how this can be done. So that was an integration. Innovation obviously is essential for potential growth, and again, Europe has fallen behind. If you look at the number of patents, interestingly, not in all areas. One area where we're still pretty good is green technologies. So green technologies can be an important source of innovation in Europe, and we should keep our strong focus on this area. Of course, innovation requires capital, not any type of capital, but risk capital. But it's not just about the funding. It's about, when you talk about like venture capital and risk capital for innovative companies, it's also about expertise, not just money. And what you need is you need to build entire ecosystems for founders where you get the money, but you also get the expertise. Demography is working against us. The aging society limits production, it also limits innovation. And so we have to be very clear that we will not be able to foster growth without immigration. And we should seize the opportunity that nowadays there may be quite a few people who are interested in coming to Europe across qualifications. We are not just talking about high qualifications, we are talking about all qualifications. And this seems to me one of the key ingredients to a growth strategy in Europe. So besides integration and innovation, we need sovereignty. And defense is at the core of sovereignty. Europe must be able to defend itself. So it's absolutely needed that defense spending is increased. But it's not just about spending, it's of course also about building a European governance for defense. In addition, we also need sovereign solutions for the digital age, cloud solutions, the area of AI that I think Andréa is going to talk about later. And I stole this slide from a presentation that Beata gave at our Sintra forum not so long ago. We need to de-risk our supply chains. We have become strongly reliant on especially Chinese raw materials, and we have to see how we deal with that. We also have to de-risk our payment systems, where we are very strongly dependent on US payment providers, and the digital euro is one way to deal with that. And of course, for sovereignty, we also need a strong currency. And this is our responsibility here at the ECB. This is why we think it's so important to foster the international role of the euro. But as President Lagarde said in a recent speech, this role needs to be earned. It doesn't just fall from the sky. In all of what I talked about before, everything related to innovation, growth, integration, defense, and so on, all of that is also the basis for a strong euro in the international sphere. And of course, the international role of the euro would also be supported by a large and liquid European bond market. And we've made some important steps in that direction, but more will be needed. So summing up, we need integration, innovation and sovereignty to maintain and strengthen Europe's place in the world and to protect our past achievements. Thank you very much.
Thank you very much. It's a great pleasure for me to be here. And it is to reflect about the challenges of Europe, but not just the challenges, but it's also to try to reflect on how do we transform challenges into opportunities. But I do want to say this today, the conference is also about spotting talent. And I want to thank the organizers for at lunch all the poster session that we've seen of all the, if I can call you like this, the upcoming talents. It was just absolutely amazing to see the depth in one poster and to have the discussion. So thank you for the organizers, and importantly, thank you for all of you who have participated in this very important and a good way of networking and getting to know all of you. So I want to turn my attention to AI. AI, we know, it has the potential to transform the way we work, to reshape the way we work and think even. But AI also comes with, and in particular now from a public authority perspective, from a central bank perspective, AI also comes with a responsibility. AI is likely to reshape the way that the financial markets work, and there is a responsibility to adopt AI in the first place, but to also ensure we can adopt a responsible, safe, and ethical AI. So how do I think about AI? AI is such a big topic, right? So I like a picture. So this is one picture I like. It's an iceberg. I know. But what do I mean by this? Because to me, AI has two sides, right? It has a visible side above the water, right? These are the things you see. These are the chat box, the analytics, the dashboard, the automation tools, all of this. The things that we use, or we should be using and adopting more. These are great, but these cannot function unless you have what is underneath the water. The things you don't necessarily see and yet are so important, right? This is, of course, all the infrastructure, the cloud, and to think about the risk around them, the cloud infrastructure, the risk in the governance. How do you make sure the models are explainable? How do you make sure you understand the data governance is a very important one. The platforms, what is it you're interacting on? And of course, very importantly, people skills and training. And unless you have this, what is happening underneath the iceberg, you will not be able to really enjoy in an effective way what I call above the water. So let me come to Europe. Where do we see, and I think Isabel mentioned a number of things, so some of the slides are very complementary. So I come from Washington, I've heard a lot, Europe, where are we? And yeah, we're a little bit behind. So here when we look about AI patents, right, there's a scope for greater AI adoption. So Europe is entering the field, but I think Isabel had also a really nice chart. In the area of AI, Europe has been moving forward, but really much, much slower than if you compare it to the US. So this is what you see. You see the red line is Europe, much fewer patents that it has issued than, say, in the US. But also, if you look at the right-hand side, the patent as a share of total patents, right? So this is what you saw. Europe may be ahead in other areas, but in the area of the digital revolution, Europe is clearly behind. So is Europe a lost cause? No. Let me show you another graph. So this is an interesting graph. This is a graph that looks at AI adoption. And what we see here is that among European firms across different countries, right, what you see here is that for some firms, so here what I do, the red line is AI adoption in the US. It's an aggregate. Whereas in Europe, we differentiate between what we call firms with a high financial development relative to low financial development. And what we see is the firms that fall into the category of high financial developments, the AI adoption is very similar to what we see in the US counterparts. So it is possible. So the question, of course, is what drives this? And one of the things is what we see, and Isabel showed it as well. Of course, there's a big sectoral difference. And this is what you see here. But what we have found is what is the driving factor if you try to explain AI adoption. Of course, there are many factors as usual, but it really is how much do firms invest in AI or in innovation more generally. And so if you superimpose this with sector, you see the sectors that are, say, very data intensive. They really are and they have to invest in that. They're much further along in the level of AI adoption than, of course, other sectors. So investment in AI, and when I mean investment in AI, right, it's in software, in data, you can really see a big difference about the ability to adopt AI. So the BIS actually did some very good work, actually some work, joint research with the EIB, highlights really the potential gains of the of productivity gains that you can do by harnessing AI. So what do we find? So they looked at 12,000 European firms, and they see that in the short run, AI adoption can increase firm-level labor productivity by about 4%. Right? This is a good amount. Now, the good news is, at least for now, that labor productivity increase is really driven by capital deepening. What do I mean by that? It is without replacing labor. So we're not seeing shedding labor and that's what makes you more productive. No, it is really the complementarity of having more capital that allows you to be more productive. Now, this kind of work, there are really three important insights. One of them is that these productivity gains, where do we see them? We see them in medium and large companies. And that is an issue. It's a little bit like the large financial deepening or not. It really is, there is a risk of fragmentation, right? About the large firm that can invest versus the others. And of course, the study also confirms what you showed in this graph, is that there is a very, very strong relationship between, or correlation between AI adoption and investment. And that's what it's interesting in software, in data system, of course, in infrastructure, and in workforce training. So given the importance of investment, what is also important, what you also see in the data, is the firms and the firms that end up being better at adopting AI are also the ones that are in countries that have much deeper financial markets. So again, this relationship between not just the size of the market, but the size is more a reflection of your ability to invest, of your deep pockets, and your ability to invest depends not only on the profits, but also your ability to access financial markets. So what does it mean for Europe? For Europe, it is about really looking that also the SME, the small and medium firms, jump on that train, and particularly on generative AI. It is about skills and retraining, and it is about offering financial access. What I want to finish with is, what about financial stability, right? Until now, I've talked about productivity gain and what it does. What does AI and financial stability mean? So again, for central banks, for regulators, we play two roles. We are big users, right, of technology, but we are also stewards of financial stability and of trust. So again, we have to lead by examples. We have to adopt AI, but we have to make sure that this adopter is also safe and responsible. So I'm not going to have any slides on this, but we know AI has opportunities, but also a number of risks. And the bigger one of the important one, and it's not a new one, is concentration. Right? We ultimately rely on few models, we rely on few infrastructure, and even we all work on the same data set. So there's issues about procyclicality, there's issue of market volatility, there are also issues of, which is a really bad one, right, of hallucination, like if we really get incorrect outputs and we don't have the critical thinking to really rethink them. But I do have one more graph. What I would say is that, yes, AI has risk, but what is interesting is how, for instance, financial regulators are really increasingly using AI. And this is what you see here. It might be very small. So it just shows that how many supervisors are experimenting, that's the red line, and developing or using, that's the yellow. And you see that in all the fields, where all of the authorities that use a lot of data, supervisor is one of them, the ability to automate, to use, to process, to manage the data really means a lot of efficiency gains. Now, efficiency gains doesn't mean you shouldn't be careful, and there really is, there is also a responsibility, an accountability towards not just looking at the efficiency gain, but making sure that you maintain the trust that goes with them. The other thing I want to say, where AI is really interesting, is particularly on the macro risk. Because one of the issues, as we all know, about macro risk was the buildup of systemic risk. They tend to build up over a long time, and you have very few events. That makes traditional empirical analysis very difficult. Well, AI, if there's one thing they're good at, is to finding a needle in the haystack, right? So AI is particularly good at recognizing patterns and at capturing complex interconnectedness among banks, non-banks, different markets. And these are areas we really ought to go into and use the ability to deepen our understanding of what is happening, particularly in the world where there are many shifts in the financial sector, and to be able to identify the risk. And I'll stop. Of course, these are great opportunities that we ought to harness, but there's one thing that is clear, is the human remains in the loop, right? The humans needs to stay there, because ultimately the accountability of the use of AI remains with us. So yes, there's going to be a lot of, we need to harness this technology, but ultimately we need to stay there. We need to stay there on the individual level, and I think this is also where international cooperation and the kind of exchanges we need to do to move together in harnessing the risk is very important. I'll stop here. Thank you very much.
Thank you very much for the invitation. It's a pleasure to be joining this panel. May I have my slides? Great. So I'm going to contribute to the same discussion, how to revive the European growth, by making 3 points. First, what's the scale of the challenge? Second, is industrial policy the answer? And third, where will the money come from? So starting with the scale of the challenge. As the tennis ball that's squeezed from two sides on my title slide, Europe finds itself between two pressure points. On the one hand, we are being left behind the US. On the other hand, China is catching up very quickly. And you can illustrate it in many ways. We saw it in Isabel's presentation. But my favorite way of doing that is looking at the list of 2,000 companies with largest global R&D spending. And what you see there is that a third of these companies is American, a quarter is Chinese, and only a fifth is European. But what's particularly striking is the fact how things have changed over the last 2 decades. The share of American companies has gone up. The share of Chinese companies has gone up tremendously, while the share of European companies has dropped. And today it seems hard to believe that 20 years ago that list was dominated by European companies. Now, what about companies from the new EU member states? They are barely present on that list. There are only 2 of them, one from Slovenia and one from Hungary, both in pharmaceutical industry. Now, do we care about the fact that the new EU member states are not there? Yes, we do care, because over the past 30 years, these countries have experienced spectacular growth because they were catching up. But now they need to change their growth model to the one based on own innovation. And unless they get their firms on that list, it's going to be hard to do. Now, the second phase of the challenge is the fact that when you look at the new EU member states and look at the middle graph, what we have observed is a drop in investment relative to GDP around the time of the global financial crisis. And this new lower level seems to have persisted since then. So it's not only that they don't have companies on that list, they also saw a dip in investment levels. And relative to other regions, public investment is more important there than plays a greater role as a share of total investment. So investment, we need to see more investment. Now, of course, investment does not need to be domestic. It can come from abroad through FDI. But here is another challenge. US is attracting a lot of FDI. And already last year, US became a net recipient country rather than a net source country when it comes to greenfield FDI. So here you see data from FT Markets database capturing just greenfield FDI projects. So that's not the full picture, but it's still a pretty good idea. It gives you a pretty good idea about what's going on. And based on the data for the first half of this year, we see a big increase in the ratio of inward FDI to outward FDI in the US. Now that contrasts sharply with Germany, where we've been seeing a decline. The remainder of the EU is doing somewhat better, but nowhere near where the US is. So basically, we are seeing increased competition for FDI. Now, remember, we are talking about Europe being left behind the US and China catching up. How do we see China catching up? Well, over the past few years, we have seen increased similarity in the structure of exports between China and Europe, and in particularly the Eastern European EU member states. China's exports are more sophisticated than what you would expect, given its income level. So China is actually competing with high-income countries and sort of upper middle-income countries in terms of export structure. But when you look at what China demands as imports, many European countries are not actually producing or exporting the goods that China demands. So in that sense, US is competing with China, but it's also producing goods that China is importing. And that's to a much lesser extent the case in the EU. Okay, so is industrial policy the answer? Well, over the last few years, we have seen a big shift in the perception of industrial policy. Right? In the 1990s, industrial policy was discredited. Now it is perceived as the best thing since sliced bread. Can industrial policy be an answer? Yes, if we do it well. Right? So everybody is doing industrial policy, but most places we are not doing it well. In our last year's transition report, we have analyzed industrial policy from 140 countries. And the picture that emerged was not particularly pretty. First of all, industrial policy tends to have multiple objectives, right? And often these objectives may be on a collision course with each other. Think about Europe. We want to electrify transport. We want lots of electric cars on the road. At the same time, we want to protect our domestic automotive industry, right? And these two objectives are on a collision course with each other. And given that we have limited appetite for subsidies, consumer subsidies for this, in a sense, they cancel each other. Second, what we also see in the data is that in vast majority of cases, industrial policy discriminates against foreign interests because it's about protection through tariffs, it's about local content requirement, it's about preferences in procurement. And that means that this more enthusiastic use of industrial policy is going to lead to further fragmentation of the global economy. Finally, most industrial policies are enacted without having an end date. So governments are signing up to spend money on particular industry, particular region, particular firm, without saying when this preferential treatment is going to end. And once you award something, it's very hard to take it back. So where we come out in the report is, yes, industrial policy can be helpful, but you need to be smart about how you're doing it, you need to do it well. And here you see some of the principles. First, it's very important to articulate the purpose and have a hierarchy of objectives so that we avoid a situation where various agencies, entities come up with policies that cancel each other. Second, industrial policy is as much about picking winners as it is about letting losers go. It's very important. Finally, it's incredibly important to let competitive forces to work and plan for phasing out. These days, where budgets in every country are stretched, where public debt is growing, it's very dangerous to sign up for spending money indefinitely. So, and that brings me to the last question. Where will the money come from, right? And, in Europe, we see a big push to increase defense spending. And actually, given the burden of the public debt, we are unlikely to see this kind of money being available in the near future for competitiveness. So I think the relevant question to put on the table is, can defense spending boost European competitiveness? And, as you see in EBRD regions, we have seen an increase in defense spending. And on the positive side, a bigger share of that spending is now devoted to investment rather than, current expenditure consumption. But I think there are three trade-offs one needs to think about in that context. First, are we spending on narrowly defined military purposes, or are we investing in broadly defined resilience? So cybersecurity, resilient infrastructure, energy diversification through renewables. Because this broadly defined investment can potentially boost competitiveness of the economy of the private sector as well. Second, there is a trade-off between obtaining what we need fast versus buying in Europe, and therefore stimulating growth in Europe. And third, there is a trade-off between having the best defense systems available today versus spending on R&D to develop the systems of tomorrow. Thank you.
Well, thank you very much to all three of you. There's so many topics there. I don't know where to start, but when we think about this sort of gap between the diagnosis and then the implementation, which of course you all live with and you've referred to, Isabel and Beata, you talked implicitly or inexplicitly about de-risking. We talk about increasing the resilience of the economy and reducing the vulnerability that is created by excessive reliance on China, but you could also say there's a vulnerability that comes from just not having a diverse supply. If you don't have a very wide range of sourcing for things, then you're going to be vulnerable to these industrial policy actions. You're going to be vulnerable to a more complex global trading system. What I'm interested in, and I think even companies in this country and other parts of Europe are interested in, is politicians and policymakers talk about de-risking, but it's not clear what their lever is for achieving that. Are they going to be actually enabling companies or subsidizing companies to change their supply chain? Do governments even know enough about their supply chain to understand which companies need to reduce their vulnerability in certain areas? So I just wondered whether either of you had thought about what the policy lever is there in principle, regardless of who's doing it or how they would do it.
Well, first of all, it's in the firm's own interest to de-risk. And we actually, we have analysis showing that de-risking is going on big time. Of course, no company will, or not, maybe not no company, but most companies will no longer just rely on a single supplier and so on. And we see that this is happening. And so it's not just about government policies, but it's also about
But it's often a lot more expensive. And if other people are not doing, there's a first mover disadvantage.
But that's a fact. Resilience is, of course, is more expensive. I mean, there's also a role for the government to play, but it's not only for the government. The firms themselves have to play a big role in that. But when it comes to thinking about, I don't know, specific raw materials and so on, there's certainly also a role for the government to play to make sure that there are contracts in place and so on, that they continue to have access to raw materials that, for example, are very important for the digital and green transition.
Because, I mean, we've seen that, Beata, with the rare earths, you know, as China increases the controls, we certainly, even journalistically, we realise we don't understand enough about where they fit in, how much they're relied on by so many different sectors. And I don't get the impression the government really knows enough either.
Well, look, getting access to critical raw materials fast is incredibly hard. So Isabel was kind enough to show the chart from our transition report 2 years ago. We looked in that report at who owns the known reserves of rare earth. And, you know, Block West owns essentially only, I think, a fifth or a tenth. But even if you own the known reserves, developing a mine takes on average 16 years, right? So it's very hard to do it fast. So I think a better bet is to de-escalate tensions so that you don't give countries supplying critical raw materials a reason to introduce restrictions. But you know, everybody is very focused on resilience of supply chains. I think we also need to worry about resilience of market access. Right? Isabel talked about the need for companies to scale up. So it's important for Europe to continue signing free trade agreements, improving our access to markets in countries that are like-minded and are interested in doing that.
I would even go one step further, because you're absolutely right. Resilience comes in different shapes and forms. And an important one is, and we've seen it again in April, how countries reacted, it's the flexibility of the economy. So it's also about labor market reforms, right? If you have a very flexible labor market, firms are much more able to reshift. We've seen it. The countries that were able to redirect the trade. So it is about supply chains, but not only. So I really think about looking at your domestic policy and making sure that you have this ability to remain agile is very important as well, and is part of your de-risking.
And by the way, it's also about technology, because in many circumstances it seems that you need this specific raw material, but it's often not true, because there are alternative ways of producing things. And so it's also about innovation and thinking about what alternative materials could be used.
Well, I was wondering about that, and Andréa, when you were talking about the AI, I mean, everyone has talked about diffusion in different ways, and you see that in many countries. You know, there's the long tail and it's the diffusion. It's the failure to diffuse the most efficient companies' expertise to the rest of the companies. So I just wondered how you would be thinking about that again in terms of practical policies in the labour market, at the educational level, to be increasing diffusion, because this isn't just about building lots of data processing centres.
No, I agree. And that's why I find it fascinating, because we all do a lot of work on AI, which is about the technology of it, right? And the efficiency. But a lot of it is also about how do we continue to train our workforce. And I think so the diffusion has a lot to do. And what I find interesting is the way we learn has totally changed. Before you would put people in courses, right? Send them back to university, which is a good thing. But today it's not. It's learning on the job. It's mobility. Again, it comes back. It can be intra-firm, but it's the ability to learn different things, to have a wider range of skills and expertise. And I think this is going to be a big part of the diffusion factor.
And I mean, EBRD has a lot of experience of.
Yeah. So in one of our reports, we looked at IT training of workers. And when we compared workers in our countries to workers in advanced economies, they were equally likely to take free training. But in EBRD regions, people were less likely to be trained by their employers. So, one policy lever is to subsidize employer training. And to come back to the demography issue, it's particularly important to do that for older workers, because what we see is that in Eastern European EU member states, people who are 50 or older, they have much weaker IT skills than their counterparts in Western Europe.
But should we be questioning, one of the things that's always been true, we should get off training in a minute, but I do think it's important. There has always been a I think a little bit of complacency in Europe that actually the slightly more firm-based approach, and often supported by collective bargaining and unions, approach to training and capturing it within a company, that has often been a powerful way to retrain workers where you can do it, certainly in Sweden and other countries. And we've tended to think that the very decentralized, relying on the individual having to do their own retraining, as in the US, has not been as effective in that. But do we think that is still true in this changing environment? Because it feels like the more individualized approach in the US is certainly post-COVID seemed to have quite a lot of advantages.
Well, given where demography is, and our new report is going to be on demography, it's important to keep older workers working, right? And given that in many cases they don't have the needed skills, I think there is a rationale for doing something, for governments to do something in that area.
Switching from the sexy topic of trading to the even sexier topic of capital market union, but I think there was you haven't talked about it as much explicitly in your panels, but in your presentations. But I do think sort of underpinning a lot of the conversation is to have a deeper capital market and a richer source of venture capital and investment funds in Europe through lots of different courses. And that is clearly something that has been understood for a really long time and has been talked about by policymakers with more and more urgency over the last few years. I think people just have a real question on the outside is, why has so little of that agenda come to pass when it seems everybody on paper is very committed to it? Isabel, you've at the sharp end of some of these discussions.
I give you one explanation, which is that everything that's happening in financial markets in Europe is very much driven by the banks. So the banks have such a strong power in European politics that the first project that is going to mature, the Capital Markets Union, is about securitization. And that has relatively little to do with the kind of capital market financing that we are actually talking about. So I think that is a big issue, that the banks are too powerful in these processes, and that those that we are talking about, the venture capitalists and so on, they don't have a comparable voice. So, I think that is something that the politicians need to do. They need to go to the startup companies and ask them, what is the real issue that you're facing? And what I'm hearing when I talk to those companies, it's really that they are missing this kind of ecosystem. I mean, we have fantastic startup hubs at various universities in Europe. Many great ideas. Young men like launching rockets, where you think, why are they doing that? But this is also how SpaceX in the end started, right? So we do have those people, but then somehow they get stuck because they don't get the funding. I mean, one of the reasons, of course, is we don't have as much like capital-based pensions. I mean, we have mostly pay-as-you-go system. That's one of the reasons, but I cannot believe that's the main reason, because of course the money can in principle also come from anywhere, and there's of course a lot of savings around. But even though I would say the normal household savings is probably not going to go into venture capital, even though some of that could. I mean, if it's money that is in insurance companies and so on, of course part of that can go to a venture capital.
I mean, and you mentioned, one of the things obviously would be very targeted at sort of the smaller startups would be that 28th regime that you mentioned. I think everyone seems to think that's a good idea, and yet what's preventing more progress on that?
I mean, it's hugely controversial, of course, because I mean, I mentioned the areas that are effective, and I take just one of them, which is labor law. And I mean, labor law is really critical. If you have a company, a young, innovative company that wants to spread out all over Europe, it's super complicated if you have to deal with 27 different labor laws. But on the other hand, of course, if you now give the right to these innovative companies to kind of use somewhat leaner regulation, then of course there's going to be a discussion about, you know, dumping and whatever, unfair competition, lowering of social standards, and so on. So that's really hugely controversial, and it's really, so the question is how we can manage, or not we, but the governments, how they can manage politically that some idea like that can fly without giving rise to too much opposition. But I think labor law is probably the most controversial one.
Now, Andrea, on the capital markets union, do you agree with Isabel that it's all the bank's fault that we haven't progressed?
I didn't say that.
No, I do think a key difference between the US and Europe is the structure of the financial sector, and that has really far-reaching implications. I think what is interesting, there's one microcosm that's interesting to look into that, is, for instance, and we've heard about this earlier today, is in the payment system where there's been many more fintech coming. So fintech were a good source of competition for banks. It's not been easy for them, but they've done tremendous work. So I think so she has a point by saying having this kind of competition is very important. Then you need to make sure, how do you create these areas of innovation, allow and really support it, and many institutions have supported, even central banks have often given some sandbox ideas, or have even opened sometimes part of the balance sheet to allow that. And then clearly to make sure how do you maintain the trust in the system. But I think there is something to do here. But the one thing that Europe does have is debt, is sovereign debt. Right? And sovereign debt creates a lot of liquidity. And so the question is, how can we use this liquidity to create the deep market? The reality is much, when you think now not about institutional investors, but you mentioned pension funds or large institutional investors, because the money is here. I mean, if you have a lot of debt, the debt needs to be held by someone. So the liability of the government is the asset of someone. Where do these assets go to? And the reality is today, if you look at the FX composition, a lot does go to the US or in different currency. Part of it is diversification. But I do think it's a chicken of the egg. There's no simple answer, but I do think there's room for maneuver.
Although going back to the Mario Draghi report, it's the joint debt that would be a good answer for that, surely.
Absolutely. I mean, I think that I think when you look at, you talked about legal, and it's absolutely true. I mean, if any of you have had to deal with it, right? Each sovereign debt is very different, has its different characteristics, is traded on a different platform. It does create a fragmentation that makes it much more difficult, despite the fact that you have a currency union, which really helps tremendously. But absolutely, there's work to do, but that's on the political side.
Mm. I mean, I think what is important is it's not just about joint debt. That's not the full answer. The joint debt has to come along with a proper governance, because otherwise, I mean, you have joint debt and you get incentive problems, and you get a system that is inherently unstable. You need, in the end, if we want to move towards a system with like more joint debt, we also need a system that moves more towards a political union. I mean, I think there's no doubt about that. Just having joint debt cannot be the answer, in my view.
I agree.
You know, one complicating factor in this whole discussion is that the electorate is getting older. Older people vote more frequently than young people, and they have different views. We need more on the technology side. They are less likely to take risks. They are less excited about technology. If you ask them about their priorities, pension spending is their priority rather than investment in education. They are less likely to be accepting of migration. And if you do the calculation, the migration flows you need are actually very large compared to sort of historical experience. So I think big challenge is how to have an adult conversation with the voters about the challenges and possible solutions.
And just on that sort of the deepening of the capital market conversation again, I just noticed that Chancellor Merz has talked about a common European stock market, stock exchange. Do you think that would be one possibility in this area?
Well, absolutely. To have European infrastructures is already one step in the right direction. You also need a more centralized supervision, which for me seems to be an absolute no-brainer. But again,
I wasn't sure what that even meant. What does a common European stock exchange actually mean?
Well, it could mean.
I mean, it just seemed it was an interesting proposal, but I wasn't sure what it meant.
Basically means consolidation. That's the way I would see it.
And on this sort of broader question of, I mean, there's one thing that goes sort of through a lot of our conversation is fostering innovation, and Andréa talked about how we promote innovation. I mean, there's always been a difficult trade-off there with innovation and regulation, because we also think there should be effective regulation. And that seems to be a particularly acute issue when it comes to AI. Certainly the perception outside Europe is that Europe, and indeed one of the things that people in the UK identify as as an advantage, maybe say one of very few advantages of Brexit, that the UK is being sort of liberated to pursue AI in a way that, whereas so many of the big platforms have been critical and wary of the European regulation. So when you think about diffusion, when you think about what the European economy needs to get from AI, is any of that at risk potentially from the regulation that has been passed or proposed?
I wonder whether there are enough firms ready to invest in AI. So firms with funding and resources and interest in Europe. So to me, that's the first order question before we even talk about regulation.
But it is the first thing that all these companies, when they talk about investing in Europe and the future of Europe in AI, that is the first thing they talk about, is the European internet legislation and the perception that is tying their hands.
But are these companies that would want to invest in Europe, or the companies that would deploy their products in Europe? And I don't think that's the same thing, right? They may be complaining about regulations because that would limit the products they could deploy in Europe.
That's interesting.
Well, so I would say there can be no doubt that in many areas we do have a bit of over-regulation, and we have to look at that also in the area of AI. But I think what is more relevant there is that, again, this is an industry which has the winner takes most features. And that means that those who were there first have this incredible first mover advantage. And it's just very hard to catch up. And we do not just see it in AI. We also see it, I mean, one very important topic is cloud technologies, right? And we see it. We have kind of the hyperscalers who offer so many features, analytics and whatever. And of course, there are providers in Europe. They're still relatively small. They're not as advanced, but they would need, the push in order to get to that level. And I think from a sovereignty point of view, I mean, one has to make sure that also in Europe these firms can thrive. One has to look at regulation, whether this poses any obstacles. But I mean, we know it's very risky to just rely on foreign firms for these essential services.
I want to pick up on that point, Isabel, because it's absolutely true, right? There's a little bit of a timing issue. So Europe comes in, a lot of in AI, a lot of the models, but also the producer of your microchips. But just think about the models, right? They all come from the cloud, all comes from the US. The models all come from the US. They're trained on US data. So I think it's going to take a little bit of time to get the confidence that these are the right things. And I think technology innovation helps. For instance, until now you have what, 4 or 5 large LLM models, these foundational models. Well, you can't really it's very hard to test them. You don't have access to the protocols. You can't, so from a sovereignty perspective, let alone it's used on the different data. But now you have small language models that are coming, that you get a greater control over them. You can run them differently. So I think it also takes a little bit of time to get confidence, because I mean it's pretty dangerous, right? If you don't realize that you're creating hallucinations. And the thing is, these issues with AI that we have, they're not bugs that will go away. They require really a different thinking, and I think that's why. So regulation might be one, but I also think when there are these sovereignty issues where the risks are pretty large, and you have to be careful before engaging.
Sorry, do you want
Just want to say, and there is, of course, the question of energy costs that was already mentioned.
Yeah, that's a big one.
And I mean, and that is one area where, and obviously Mario Draghi also highlighted this importance of reducing the internal barriers within the European Union, and one of the big one of the big effects of that is to improve investment and lower the cost of energy. I mean, all of these recommendations, almost all of them, have been endorsed by leaders, by Ursula von der Leyen. Is there a way to cut through some of that apathy, or the slow pace of change? I mean, if you think about how much has changed in the year since Mario Draghi delivered his report, the world has moved on very fast. Supply chains have become very complicated. The cost of energy, or the needs of energy, have become even greater as we look at the demands of AI and other things. And yet so little movement on that report. I mean, is there, just as a question of advising the member states that really do want to make progress on this, what are the best things for them to be pressing on to do better?
See, I wonder whether this is an issue of bandwidth of policymakers, right? A year ago, we talked about Draghi's report. It has shaken up Europe, and there was interest and willingness to do something. And then other shocks have taken place, and suddenly more urgent things have become priorities, and competitiveness has fallen down the priority list because there are other things that one needs to take.
But a lot of the things that have happened have made those challenges more urgent. I mean, if you have diversion of Chinese imports that were going to the US and now coming to Europe, so that's increasing the competition for European companies. You've written about it as a demand shock for European companies. I mean, I would have almost thought the opposite. I would have thought it would have increased the level of feeling of urgency.
It has, but defense is the top priority. Then there was the issue of trade relationship with the US that was very urgent. So, I think that could be one explanation.
What should they do?
So first of all, I think this kind of counting in terms of percent of Draghi recommendations, I don't think that's a very good way to proceed. I mean, it's good to show that too little has happened.
Would you say that the important stuff in the report has been implemented?
But that is the main thing.
Yeah.
I mean, you said there is a large number of recommendations in the Draghi report. And maybe the number is still much too large. So the first step would be to identify, which are the true game changers? Which are the things that really matter, and to focus on those, and not do everything at the same time, which then takes forever, but to identify like the 5 key projects that really have to happen. For me, the 28th regime would be one of them, but there are of course others. And to focus on those and to not focus on 363 projects. And if you can deliver on the 5 key projects, that would be enormous. I mean, apart from that, I do think a lot of things are happening. I was personally very surprised that the Draghi and the Letter report were perceived in that way by the political system. I found that very surprising, that they really took that on and said, okay, this is our agenda. I mean, that we have to pursue it. That's quite impressive, and at least things are, I think, going in the right direction, too slowly, of course. But I think it also has to be seen that this is quite something, that these reports had such a big impact.
Do you think, we're going to go to questions in 1 minute, the only other, to sort of inject a little bit more optimism into the conversation, I mean, there is one thing that has really changed. I mean, we spend a lot of time worrying about the structural issues and the instability in France, the core economies of the Eurozone, seemingly finding it very difficult to move forward in key priorities, very obviously in the case of France, but it's also, one has that feeling around Germany. The flip side of that is some of the countries that we've always thought would find it harder to achieve structural reform and sustainable growth, manage their fiscal policies, are actually doing extremely well in the south, or at least relatively speaking. You know, the higher performers are now Greece, Spain, Italy, Portugal. So I just wondered, are there opportunities there? Is there scope for those countries to be sort of pulling the European economy forward in a way that has maybe not been the case in the past?
Well, let me add that Poland is doing very
Poland's
well, right?
Yeah.
Among fastest growing in its region. And what is helping there is, it's a larger economy, so it's more diversified, so it's less influenced by external shocks, external demand, particularly sort of weaker performance of Germany. And also, public investment is helping out. So, again, coming back to the need not only to invest money, but also by governments, but to invest it wisely.
So I'm going to make a very basic point here. A lot of it is about investment, right? And you're asking us, you're asking Isabel, you're asking me, with the Bank of Central Bank, what's happening on the political level. Well, I'm going to say, in order to invest, fine, you need money, but you need trust in money. And I think this is what central banks do, and you need trust in money that's in the value of your money, that's your monetary policy, that's financial stability, because you need to invest, because in order to invest, you need to have predictability in the future, and you have to have confidence in the future, and you need to be able to calculate your return on investment. And also, and this is where innovation has also played a very big role, you need to be able to pay to transact internationally. Domestically, of course, but that works well, but also internationally. And I think that it's more of a rail system here. It's like, how do you how do you invest? How do you pay? How do you make all of this with trust? And I think this is an area where innovation is really at full bloom. We also have the whole tokenization, the whole blockchain. And I think this is very important area, and that opens up a lot of opportunities also to get it right. And I think this is an area where central banks are more comfortable, because that's within the mandates to move forward and make sure that you also create conditions that allow for investment to bloom.
Mm-hmm. Okay,
Yeah.
I'm sure there's good. Oh, sorry, yeah.
Very briefly. So, I mean, one of the things, of course, that is has been holding Europe back is that we're always trying to form a consensus on everything, and in certain areas we also need unanimity and so on. And that has been holding Europe back. And so I think we need to move more in the direction of allowing for coalitions of the willing, because you said in some countries it may be easier than in others. And actually, if some move ahead, others may then find it easier to follow.
We will see. Okay, so there's a question in the front row. We might take two here, and then we'll...
Thank you very much for the fascinating discussion. My name's Yuan, I'm from University of Chicago. Thanks to European talents, especially past PhD alums of University of Bonn, some of you you may have taught Isabel, we've collected hundreds and thousands of years of data to show that the rise of scale and large-scale firms is a historic inevitability and extremely important for innovation, but with two caveats. One is, in the data we see that these large firms predominantly get larger with capital, not employment. And two is, of course, there's always sour popular sentiment against large firms, against scale. And interestingly, in the US these days, probably many of these panels will be talking about inequality, about market power, political influence, and social concerns about scale. So how do you think one can strike a balance to take advantage of the technological necessity of scale, but then also avoid polarization and imbalances?
Okay, and I'll take the question here as well.
Irina Steven from the University of Hamburg. I have one question to Isabel and one comment to Beata. Isabel, given that we know that firms rely in Europe so much on banks, and we've been talking about banking integration. We know that the cross-border bank to non-bank flows are so low across European countries. Why do we not still have something like Euro-wide credit register? And for Beata, you talked about investment in defense and innovation in defense. And I think that one of the positive sides of this terrible war in Ukraine could be the possibility of the defense firms to have this testing ground for all the innovations. And this is what we see that in the last couple of months is German firms have started to do. But this is where we could push much more and also use this as an innovation in defense. Thank you.
Okay, we have a pretty broad question and then two quite specific questions. I don't know, do you want to take on the specific questions first? Yeah,
I'm happy to take. So on the, so who innovates, right? If you look at who patents, it's large firms, multinationals, and then, startups. And yet, any multilateral development bank, government agency spends a lot of money supporting SMEs, right? We should be supporting young firms, not small firms. It's a point that's very obvious in this room. We should be supporting R&D through maybe tax credit that would go to large firms. This is politically very unpopular because politically there is this perception that we should be helping weaker firms, right? And somehow we need to change the discourse and educate the public about it, but it's incredibly hard. On R&D investment, I think this large funding that is available for defense, big chunk of it must be used for R&D. Otherwise, we have no hope of catching up with the US.
Mm.
Can I ask, because it's a broad question, it's a very good question. In my view, it has two words as an answer: fiscal policy or regulation, right? But I mean, that's a political decision. So it's a simple distribution of wealth, right, across the economy. And I think that's where ultimately it's a political question and it should be addressed to fiscal policy.
Though it hasn't traditionally been a simple distribution of wealth, but yes. I mean, it's not a simple question to solve. It's just a political question.
No, I didn't say the implementation is easy, but conceptually, this is the best tool because you don't want to squash the innovation, right? You want that, but then the other objective that as a country you may want to achieve, and then this is where you get public policies. And from the range, so this is not necessarily a structural policy, it would be more a fiscal. Of course, you mentioned tax credit for other things, so then it comes into that. But that's the way I think about it, because you want to really encourage innovation. And innovation is going to have those effects. But you want that. But then there's a way to deal with it in order to fulfill other objectives.
So a very, very interesting question on firm size. So a couple of weeks ago, I was in Italy, in Milan, and I was walking along the city center. It's really nice because you have all these wonderful, nice little stores that have basically disappeared in Germany. So of course, probably many of these stores are not terribly productive, but we still like them, and so it's. So there is something also to having smaller firms. I mean, the thing is, we have to. If you look at my chart, you probably couldn't see it because it was too small. But according to that data, 30% of euro area firms have less than 10 employees, and 50% of euro area firms have less than 50 employees. So we are really talking about very, very small firms. We are not talking about do we want to have firms that are large or super large, but we're really talking about do we want to have tiny firms or like a bit larger firms where maybe the downsides that you mentioned do not yet fully come up. But it's absolutely clear that firms can also be too large. So Irina, on your question, I mean, we do have a credit registry for corporate loans, right? The ANA credit. We hopefully will also have that for household loans not too far in the future, but in principle, we are moving in precisely that direction.
Just one thing on the small firms, it's just something I noticed in the UK. I mean, there's everywhere actually. I mean, politicians tend to really like doing things for small companies because it's associated with dynamism, as it goes to your point. And actually, you should far more often be focusing on the fast-growing firms, and it's not about. But they use size as a sort of a proxy for dynamism, and it's just. I mean, to your point, it's just not the case. But anyway.
But actually, I mean, those who have the closest connections to the government are typically the large incumbents, many of who are not very.
But all the special sort of tax credits and the exciting things to do with R&D tend to often be for the small companies, and they could have been 5 people for 10 years. You know? Mm-hmm. Anyway. It's my little bugbear. I think we've probably not got time for any more questions unless there was a really pressing one question, a really good question. No one wants that. Okay.
May I say one more point, because I always think it's underemphasized with regard to capital markets union. Nobody talks about it, but I learned that many things are about taxes. When you have a problem, many of the things are about taxes. And there's one really big tax distortion that we have, which is the tax bias which benefits debt and disadvantages equity. I think that is actually, it's also one of these really big issues that could be solved and that would make a huge difference.
Except you've already identified why one of the reasons it doesn't happen is it's not good for banks.
You're right.
So, we know why that's not happening. With apology, I wanted to ask one more question, but just as more of a sort of how should we think about this problem, because I think it comes up with the IT, and I just want to take advantage of having such a great panel. We hosted a conference for professional economists last week at Bloomberg, which I'm afraid was not only women, although there were plenty of women. And one of the speakers, an eminent academic, said in describing Europe's position and looking at the share of the economy and demographics over time, looking at the future, he said, in the future, Europe is going to be like Switzerland to the rest of the world. Still fairly affluent, but just not important for anything. Now, again, with apologies to the Swiss. I know, I did apologise to the Swiss, and of course there are some Swiss people that are very important, but as a global concept, I just wondered whether that was optimistic. I mean, are there risks in this environment to our basic ability to maintain that level of standard of living if there could be sort of really quite dramatic technological change that so far Europe is not grasping? With one sentence, do you think that is an optimistic or a pessimistic view of Europe in the future, Europe's global chances?
I think we need to start addressing demographic trends today while it's still politically feasible, because tomorrow it's going to be too late. Right? And depending on whether we do it, we are going to find ourselves in a better place or worse place. We may not be Switzerland because
I do recognise we're not accepting the Swiss parallel. I'm just waiting, but just
I'm not going to comment on that one. I'm not going to comment on that one. Look, I'm wondering whether we are not coming out of a long history, and I saw some beautiful panels that of concentration, globalization clearly, and whether there is something about diversity. In the true sense of the word, why do we all regions need to look the same, to have a similar financial system? Why is one necessarily better? Because I think resilience is exactly to have different things. If you look at Asia, they're organized very differently in many different ways. And maybe that is what is going to give us resilience going forward, is not all to want to go to one standard. And I think, because in some areas, I think Europe is standing up relative to what is happening in other parts of the world. So I think it depends, first of all, what the objective is. But I also think let's embrace diversity in its true term. I'll stop there.
Including on the shopping streets. Yeah.
Including on the shopping streets.
So one sentence. I think if we don't maintain our influence, we will not maintain our affluence.
Oh, that's
great
a nice
line.
Wow,
right, we can all steal that.
Very nice.
I think that is it for today. But as you know, there's another full day of exciting discussions tomorrow. Thank you very much.
All right.